This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Home sweet home. What's behind the surge in prices, which just recorded their strongest annual gain in more than 7 years?
Big run for small caps. The sector has soared 23% so far this year, sitting now just below all-time highs. But have these stocks gone too far, too fast, or is there more money to be made?
Dollars and cents. Who pays for college? Well, it's not mom and dad. They're paying less these days, shifting more of the financial burden onto the student. All of that and more tonight on Nightly Business Report for Tuesday, July 30th.
Good evening, everyone, and welcome. I'm Tyler Matheson alongside Sue Herrera. Susie Garrett has the night off. We begin tonight with more good news about housing, specifically rising home values. The S&P Case-Shiller Home Price Index for May showed that home prices in the nation's 20 largest cities rose 2.4% from April and more than 12% from May of just a year ago. That is the largest year-over-year increase in prices since 2006, before the start of the housing crisis. Home prices in Denver and Dallas are now at their highest levels since the year 2000. Survey Director Robert Schiller, also an economics professor at Yale, expects those home prices to keep on heading higher.
For a short-term investor, there's a more sure thing in the real estate market. I mean, I think that when it's up 12% in a year, and it's uniform across, well, somewhat uniform across so many different cities, it's probably going to go for another year.
Well, those rising prices are likely on the mind of Federal Reserve Chairman Ben Bernanke as he arrived at the central bank this morning to kick off a two-day meeting on interest rates. The Fed is expected to keep its benchmark short-term interest rate right where it is, pretty close to 0% for the foreseeable future. But what Wall Street really wants to hear is when the central bank might begin pulling back on its $85 billion in monthly bond purchases. They're designed to keep mortgage rates and other long-term rates lower and spark more bank lending.
Supporters are calling it a grand bargain. Detractors calling it awful. President Obama offering now Republicans a deal that he hopes they can't refuse: lower overall corporate taxes and, in return, money to spend on the creation of jobs for the middle class. That's how he puts it. Here's how the president described the plan at an Amazon.com warehouse in Chattanooga, Tennessee today.
Here's the bottom line. I'm willing to work with Republicans on reforming our corporate tax code as long as we use the money from transitioning to a simpler tax system for a significant investment in creating middle-class jobs. That's the deal.
But some Republicans, maybe predictably, not buying it. Former Senator Judd Gregg of New Hampshire was quick to criticize the president's offer.
Sounds like an awful plan. Cutting taxes is a great idea, but then the government redirecting the revenues makes no sense at all. Let the market decide where those revenues should go. One of our biggest problems in this country today is that we have a tax law which incentivizes people to invest for the purposes of avoiding taxes rather than for getting the best return.
On Wall Street, stocks end the day mixed following a low-volume up-and-down session as investors looked for direction. A mostly positive string of earnings before the bell was then offset by concerns about what the Federal Reserve will decide to do about its stimulus plan. In the end, the Dow was up 72 points for a time, but then ended 1 point lower. The Nasdaq added 17 points. The S&P 500 closed a fraction of a point higher. And coming up, we'll talk about a big run-up in small-cap stocks and whether that can continue.
A massive merger in healthcare announced today. Hospital owner Community Health Systems is buying rival not-for-profit hospital operator Health Management Associates for $3.9 billion. That creates a huge national hospital chain, and this comes just ahead, of course, of the healthcare system overhaul expected to provide coverage to millions more Americans. Shares of both companies, though, ended lower today, HMA tumbling nearly 11%.
There's a huge find to tell you about in the drug world. Wyeth Pharmaceuticals, which was bought out by Pfizer in 2009, has agreed to pay $491 million to settle criminal and civil charges after unlawfully marketing a drug called Rapamune for uses not approved by the FDA. Rapamune was okayed to help prevent the body's immune system from rejecting a transplanted kidney. But Wyeth is accused of training its sales staff to push the drug for use with other organ transplants.
J.P. Morgan Chase, the nation's biggest bank by some measures, agreed to pay $410 million to federal energy regulators to settle charges that its traders manipulated electricity markets in California and the Middle West. Traders allegedly used improper bidding strategies that forced overpayments by the local agencies running power grids in those areas. Now, the bank did not admit any wrongdoing as part of the settlement, and none of the traders involved will face sanctions or criminal charges. This is just the latest example of a story Nightly Business Report brought you last week involving the complicated and profitable world of banks operating in commodities markets. Kate Kelly's been following this story for us closely and joins us now. You know, last week we heard about banks that were operating storage facilities for commodities, whether it was aluminum, copper, and others. Now this settlement in the electricity markets. What are the banks doing?
Well, the banks for a number of years now, Tyler, and a bunch of them have owned physical commodities as well as trading paper commodities, if you will, futures, derivatives, and other things that are in the financial markets. But they've owned these physical commodities like metal storage, like power plants, if you will. And the point of it has been ostensibly to complement the businesses that they already have, to perhaps give them some added knowledge, maybe even a trading edge in some cases, or just purely as a good investment that's going to make returns. Now, though, some of that is coming under question. For one thing, there's a deadline in September at which Goldman Sachs and Morgan Stanley hit sort of a 5-year anniversary of becoming bank holding companies, which subjects them to a different raft of regulations when it comes to commodities holdings and could potentially force them to sell them off.
You know, Congress is getting involved now, and they're asking questions, wondering whether or not banks should be allowed to have any role in the commodities market, physical or paper-wise. What are you hearing?
Well, I'm hearing a number of things. It depends on which bank and which holdings, of course.
Right.
There are concerns that some of these business activities pass on higher cost to customers. For example, with the aluminum Goldman situation, is the metal storage business, which is known for stockpiling metals and keeping them in storage longer than perhaps it needs to, jacking up prices on consumers? So that's created some questions. At the same time, you know, if the banks get rid of their commodities holdings, they're going to go somewhere. And in many cases, they may go to Europe and be handled by companies that are beyond the reach of U.S. regulators and perhaps will have even less transparency. So there are issues on both sides with either letting the banks keep these businesses or allowing other competitors to come in and possibly take them offshore.
When we first told this story last week, it was one of those who knew banks were doing this kind of stories. Kate Kelly, thank you very much. Sue?
Well, in corporate news, shares of Goodyear Tire and Rubber shot up 9% today after blowout earnings last quarter. Profits more than doubled by selling more tires around the world, led by a 4% increase in Latin America.
Profits at Chrysler also revving higher. Net income last quarter rose 16%, helped by strong sales in the U.S., especially for pickups and Jeeps. This marks the 8th straight quarterly profit for the bailed-out automaker, which is now majority owned by Italy's Fiat. And joining us now to talk more about the U.S. auto industry is John Casessa. He is managing director at Guggenheim Securities. John, welcome back. Good to have you on Nightly Business Report. I guess there is kind of a drumbeat that adds up to this. American cars are back. Do you agree?
I do agree. I mean, the market's back and Americans are buying cars, but the U.S. companies are competitive, the most competitive they've been in probably 40 years. I mean, back to the first oil crisis.
And can that continue, John? Because, you know, there's some talk that U.S. growth may slow a little bit. If the, if the Fed starts raising interest rates, does that change the scenario or not?
Well, I think as it relates to the whole market, the average age of a car in the United States is 11 years. Mm-hmm. Almost 90% of Americans get to work by car. So the car is a necessity. The fleet is old. It has to be replaced. So unless rates skyrocket, I think auto sales will continue to be healthy. As it relates to the competitiveness of the U.S. companies, you know, even through the crisis, they had been getting their act together with productivity, quality, design, and styling. And once they got through the restructuring and their balance sheets were better, they were able to plow money back into product. So Chrysler's selling a lot of the new Dodge Ram. Ford's selling a spectacular new Ford Fusion. GM's Chevy Impala got almost the highest rating ever for a sedan in Consumer Reports. That money spent over time is starting to pay off today, and they're competitive now with the Japanese.
What are you seeing in terms of market share of the U.S. automakers in the U.S.? How has it changed, if at all? Is the needle actually moving?
Well, it's moving a little bit. This year, they have about 46% of the market. That's up from a low of 44% 2 years ago. But to put that in context, 30 years ago, in 1983, they had 73% of the market. So there's been a very long slide, and in the last few years, that chart's turned up. And I would say now that share is up in 2010, in 2011, 2012, you know, there's really some sustainable momentum here. It's not a fluke.
There's a lot of talk that Chrysler will go public, and perhaps the market conditions that you described would make it a very conducive time for them to do so.
Well, I think it's right. I mean, these auto companies, it's very hard to be private. You need a lot of capital, so the public markets make sense. Auto sales in the U.S. will probably rise for at least a few more years. And Chrysler's got a lot of new product coming, so I think there'll be good investor appetite for the IPO when it comes.
What have they done right, apart from styling and improved quality?
Well, as it relates to all of the big three, you know, they have completely reconfigured their plants. They've changed their relationship with labor. They've streamlined the product development process. So instead of taking 6 years to do a car, they can do it in 3 years like the Japanese. So they're more in sync with the market when the cars come. And of course, they've also spent a lot of money on powertrain. These cars get more fuel economy, even though just as big as they were 5 years ago.
You know, the electric car movement does not seem to have gained as much traction in certain parts of the country that a lot of people thought it would. Do you agree or not?
Well, it's a fact. Those cars are not selling that well. And I think there are two things that will get them to sell well. Either gas prices need to go up a lot, and or battery prices need to come down a lot. So, you know, in a conventional car, the engine's $5,000. In an electric car, you take that out and replace it with $15,000 of batteries. That's a big premium.
John Cassessa, thank you very much. John is Senior Managing Director at Guggenheim Securities.
And we want to know what you think about the comeback of the American auto industry. So we went out to see if you're buying American cars.
American cars have gotten higher quality in the past few years.
I think there's some really affordable cars that have become better, like the Ford Fiesta Focus kind of thing.
I probably would not consider buying an American car.
I would actually consider another Taurus.
I did not consider an American car.
I was very close to getting the Chevy Cobalt, but at the end of the day, went with a better price.
I will buy an American car next car.
And still to come, if you build it, will they come? Those investing hundreds of millions of dollars in rehabbing old stadiums or building new ones hope the answer is yes. But first, a look at how the international markets closed today. Every major city has at least one sports arena, with more being built, refurbished, or on the drawing board every year. But is the big business of sports stadiums a good business to be in? And ultimately, who really pays for all those new venues? Jane Wells has the story.
I spent a couple of days in the Forum Club one night.
Nothing says classic California like the Eagles, and nothing says classic LA rock concerts like the Forum. But the once fabulous Forum is nearly as dilapidated as the original in Rome. But now, men from the East have come to make it shine again.
We will make the Forum a place where great performers will put on great shows.
The Madison Square Garden Company is spending $100 million to rehab the Forum in Inglewood to take on powerhouse AEG's Staples Center across town. Why the Forum?
It's why not the Forum? What an opportunity. The second biggest market in the world, the biggest entertainment market in the world, underserved with an iconic venue that fell in disrepair.
Built by Jack Kent Cooke in 1967, this is where Jerry West played. Fans saw Wayne Gretzky, Showtime with Magic and Kareem. But it's also where Elvis performed, Led Zeppelin, the Rolling Stones, and every major act from the 70s, 80s, and 90s. And to christen the new Forum next January, the Eagles will stage 3 shows.
This was always sort of the holy grail, you know, for us in Los Angeles. And besides that, it was just a great sounding room. It was, I don't know exactly how to explain it. It just sounds good. It feels good. It's intimate despite its size.
But the stadium business is tough. Bankrupt Detroit is moving forward with selling bonds to help build a venue for the Red Wings. Washington wants to build a soccer stadium. And for MSG, it's spending $1 billion to renovate Madison Square Garden. But New York will not commit to letting the Garden stay at its location beyond another decade. why come to LA and take on AEG?
The Staples Center is so overbooked, so many teams and so many events happening there. They believe that the market can support another major venue.
The company says the new forum will have a $1.4 billion impact over 30 years. Inglewood officials are willing to forgive nearly $20 million in loans if certain benchmarks are met. There's already a naming rights deal with Chase. And if all goes according to plan, the forum will return to its glory days and not turn into a financial Hotel California.
Thank you for a real place to play in Los Angeles.
For Nightly Business Report, Jane Wells, Inglewood, California.
Action in several sectors in our market focus tonight, beginning with biotech. Alexion Pharmaceuticals, fresh off a blowout quarter, soared again today on its reports that it's hired Goldman Sachs to consider overtures from Roche Pharmaceuticals. Alexion specialized in so-called orphan drugs, which are treatments for rare diseases. Alexion gained more than 6%, closing at $117.08. And investors bid up shares of Amgen, awaiting the after-the-bell earnings, and were rewarded with a strong quarterly performance. Revenues increased 5%. Profits were well above analysts' estimates. Amgen concentrates on cancer treatments, but makes drugs to treat other conditions as well. Volume was heavier than normal during the session. Amgen gained more than 1.5% to close at $111.20 a share. And Facebook shares closed in on its IPO price of $38 a share, not seen since May of 2012, as investors rekindled their interest in social media following last week's breakthrough earnings report. Shares of Facebook jumped more than 6% to close at $37.63. That's just 37 cents away from that IPO price. Volume was more than 1.5 times the usual pace. Merck, Pfizer, the two big pharmaceutical companies in the Dow 30, reported before the bell this morning. Merck's profit fell as patent losses on some drugs hurt their sales. Pfizer has the same patent loss problems, but profits jumped as it sold non-core assets. Investors traded both companies at above-average volumes. At day's end, Merck lost just a fraction, closing at $48.05. Pfizer had a small gain to $29.67 a share. Ty?
Buffalo Wild Wings net earnings grew. Total revenue jumped 27%. The company said it remains confident it's going to achieve 17% profit growth for 2013. That sounds pretty good, except the chickens. But investors were expecting more. The stock drooped before the close and then dropped further on the earnings news. Buffalo Wild Wings at $97.69 at the close. Coach's profits matched estimates. Revenues were a bit shy, but the stock dropped at the open and was down all day. Coach said both the North American president and the COO are going to leave at the end of August, and that it was selling a subsidiary brand back to its founder. Investors sold off on 6 times the normal volume. Coach closed down almost 8% at $53.30. And fertilizer stocks in the U.S. and elsewhere had a very rough day because a cartel that had supported the price of potash, a key ingredient in many fertilizers, collapsed. Investors, fearing lower prices for fertilizer, got out of the stocks big time. Shares fell sharply on high volumes. Mosaic, 10 times normal. Potash, 12 times normal. Intrepid Potash, 40 times the normal volume, all heading lower.
So let's turn our focus now to another area of the markets, the small cap stocks. Small cap stocks have been on a tear this year, producing large returns, with the Russell 2000 adding to its year-to-date gains and recent record highs. But is the run-up in the small cap stocks coming to an end? Let's ask Christina Hooper. She is investment strategist at Allianz Global Investors. Christina, welcome. Nice to have you on Nightly Business Report.
Thanks for having me.
I believe you think the small caps still have a little bit more room to run. Tell me why.
Well, we think over the long term, small caps make a great investment choice for investors, merely because we're in an environment of financial repression. We're going to be there for a long time, and that really necessitates moving out on the risk spectrum, having exposure to a variety of different risk assets, and that includes small caps. Now, over the shorter term, we're excited about small caps. We do think there's some positive aspects of small caps, namely that typically in a rising rate environment, small caps have outperformed. That's typically coupled with an economic recovery. In addition, one thing that I think is being overlooked by a lot of investors today is the fact that companies are sitting on record levels of cash. And typically one of the significant ways they deploy that cash is through purchases, mergers, acquisitions, and that could really benefit small cap stocks.
Quick question, then a quick follow-up, if I might, Christina. You used the phrase financial repression. What does that mean?
That means an environment where rates are held artificially low. And we are in that environment, and we anticipate we'll continue to be in that environment for years to come. There's a real asphyxiation of yield going on for many traditional sources of income.
You know, in some of the research I was doing this afternoon, I was struck by the fact that there is some sort of nexus, maybe an inverse nexus, between how domestic small cap companies fare and how the emerging market shares fare. Can you probe that a little bit for us, or what the theory is?
Well, it seems that investors who are looking for growth either favor emerging markets or small caps, or at least that's the theory behind it. However, I would argue that there is so much cash sitting on the sidelines, sitting in cash, sitting in core fixed income, that could easily move into both emerging markets and small caps, that it's not an either-or proposition
anymore. There's enough fuel to fuel both, in your view.
Absolutely.
What about the dividend play for small caps?
Well, we think investors need to look for yield in all kinds of places. And if they're moving out on the risk spectrum and they're having exposure to risk assets, including small caps, they should be looking for dividend income even in small cap stocks. So that's why we're excited about dividend paying small caps.
So what percentage of a typical investor's portfolio should be in small companies? And are there certain sectors of that, subsectors of that broad universe that you favor right now?
Well, there's no one percentage because it really depends on an investor's risk profile. But we think there needs to be a diversification of risk assets. There might be some tactical allocation amongst different risk asset classes, but there also needs to be some long-term exposure to areas like small caps. In terms of areas within small caps, cyclicals are showing a lot of attractive values right now. So, for example, industrials, materials, those areas have continue to have attractive valuations.
All right, Christina, we'll leave it there. Thank you very much for joining us. Christina Hooper, investment strategist at Allianz Global Investors.
Thank you.
Coming up, tuition is rising and parents aren't willing to pay as much for college as they used to. So what's a student to do? That story's next. But first, how commodities, treasuries, and currencies performed today.
It is a big day for a tiny college in Kentucky, Center College, Danville, Kentucky, with fewer than 1,400 students and best known for hosting a vice presidential candidates debate last year, just received one of the largest gifts ever given to a school. Center was given stock holdings worth $250 million from the A. Eugene Brockman Charitable Trust. The school says it's going to use the money to set up 40 annual merit-based scholarships in the fields of science, computer science, and economics.
Well, with the exception of those deserving students at Center College, tuition bills nonetheless are skyrocketing, forcing some big changes these days over who's paying for college. And it's not necessarily mom and dad anymore. A new study shows that parents are no longer paying for the majority of college tuition bills. That burden now falls on students, who often have to find their own resources. And more of them are now getting free help. Sharon Epperson has our story.
More and more students are searching for and finding free money to pay for a large chunk of their college tab.
I looked into the school basically that could supply me the most money. There's a lot of institutions in this country that are publicly funded that offer affordable ways to go to college.
For many families, cost has become the top criteria when choosing a college.
She's actually going to be going online and looking at any and all scholarships that she can find.
The burden of who pays for college is shifting to the student, as parents foot a smaller portion of the college tuition bill.
We can't afford to send her and her sister paying the whole thing, so she's going to have to pick up some of the tab as well.
A student's ability to find free money has trumped contributions from parents these days. A new study finds scholarships and grants are now the top sources for paying for college.
We're seeing that grants and scholarships pay for 30%
of an undergraduate education, supplanting parent income and savings, which now have fallen to 27% of the share of college costs.
6 out of 10 families say they've done an online scholarship search in the college planning process. Experts say finding resources that help students plan for how they'll pay for their entire college career is essential.
Make sure you look at all the sources, develop that plan, and make sure that the student is successful in achieving that degree.
For Nightly Business Report, I'm Sharon Epperson.
And join us tomorrow right here on Nightly Business Report when we begin our 3-part series on how to navigate long-term care, covering everything from when to buy insurance to what it pays for to how to pay for it. And tell us which stocks you'd like our Market Monitor guest to discuss this coming Friday. Click the link on our website, nbr.com, to submit your question, and don't forget to tell us where you're from.
Absolutely. That'll do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. Susie Guerra will be back tomorrow.
And I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody. We'll see you right back here tomorrow night.
Nightly Business Report has been brought to you by sailing through the heart of historic cities and landscapes on a river. You get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Tyler Matheson with a Nightly Business Report news brief. Home prices in the nation's 20 largest cities rose 12% in May over the same month 1 year ago. The Federal Reserve began a 2-day meeting on interest rates as Wall Street watches for any indication of pulling back on its stimulus plans. And on Wall Street, concerns about the Fed's next moves kept stocks in a quite narrow range. The Dow up 72 points for a time, ended 1 point lower. The Nasdaq added 17. The S&P 500 closed a fraction of a point higher. President Obama is offering what he calls a grand bargain, lower corporate taxes, and in return, money to create jobs for the middle class. Nearly every metro area in the U.S. saw its jobless rate rise in June as college grads looked for their first jobs. And tune in to Nightly Business Report here on your public television station.